555
you made for the investor after the cost.
Yes, sir.
And you paid 2,500 rupees to the broker.
Yes, yes.
Okay.
Any more questions? Thank you, sir.
Thank you.
Good morning, everyone. Today, I, Anushka Channa, on behalf of Team Finetics, would be taking you through our investment summary. The agenda for my presentation would be, first I'll be taking you through the investment philosophy followed by our team, then the risk profiling of our team and the stock selection process. Lastly, we'll be going through the weekly results and the portfolio evaluation. Before I begin with our presentation, I would like to introduce you to my team. Our portfolio manager is Mr. Sujit Kumar Baral. Our research analyst is Ms. Parvati Verma and myself. Resham Trivedi is our technical analyst and Sunit Hegde is our quant analyst. Now I'll take you through the risk profiling of our team. Our team had a medium risk appetite of about 64% and a composure of about 47%. This data we had taken from a test taken on Barclays risk profile assessment test. Now I'll take you through our investment philosophy. Our investment philosophy is to identify fundamentally strong businesses and invest in companies which have good earning prospects in their core business areas. The investment mandate that was set to us by our college was that we were given a total corpus of about rupees 1.25 lakhs. The investment horizon that we were given was for 2 months. The stock universe that we were given was for NSE and BSE 500 stocks. We also had a requirement that the company market capitalization should be greater than 300 crores, and there was also a mandate that about 90% of the total corpus should be invested at one particular time. Next, I would like to take you through our investment approach. This is the approach that we had followed while selecting our stocks fundamentally. So there were 3 criteria that we had selected. First was the financial criteria. In financial criteria, we looked for companies which had free cash flow, which was greater than 10 million rupees. We had seen for companies which had ROCE, which was greater than 10%. The revenue growth, minimum revenue growth for year on year had to be 10%. And we chose for companies which had low debt to equity ratio. The business criteria that we had taken for choosing our companies was that the company should have a leading market position and have a good pricing power. Also, the company should have good industry growth opportunities in its industry. The governance criteria that we had chosen, that we had selected were that we had looked into the board composition, management team and corporate governance standards of the company selected. Now I'll take you through the stock selection process. As you can see in the diagram that we were given a stock universe of NSE BSE 500 stocks, out of which we applied the financial criteria as mentioned in the previous slide. After applying those financial criteria, we came up to a stock of some 29 stocks. On those 29 stocks, we did a sector analysis. While doing the sector analysis, we decided that we would leave out sectors of energy, metal and reality. The reason why we did not go for these sectors was that one, energy sector was, the market was not conducive right at this point of time to invest into this sector. Metal sector, why we left that sector was that it's a from the very beginning, it's a very speculative sector. So we did not want to invest into such a sector for this horizon that we had. In reality sector, the problem was that the projects are of a very longer duration. So investing into this sector for a shorter period of time again was not a good option. As you can see in the diagram that we have also shown the 3 months return for these sectors and the Sharpe ratio for all the sectors. So based on this also we decided that these 3 sectors should be avoided. So once we applied this filter, we came up to 27 stocks. When we reached to these 27 stocks, the next filter that we applied was on quantitative analysis. We used the Sharpe ratio, where we ranked the companies, first we divided the companies into the industries and ranked them industry wise based on their Sharpe ratio, and picked up the top companies. So once we did the whole criteria, we reached up till 18 stocks. Now on these 18 stocks, what next we did was we fundamentally analyze these companies based on the two other criteria that we had mentioned in the previous slide, that is based on the business criteria and the governance criteria of the companies. So out of those 18 stocks, we reached up to 12 stocks. Now on those 12 stocks, then what we did was we analyzed those companies based on the price momentum and finally came up with 6 stocks. So these 6 stocks were Amar Raja Batteries, Bata India, HCL Tech, KPIT Technologies, Idea Cellular and CCL Products. The rest 6 stocks we kept as backup stocks. The reason we kept them as backup stocks were because they were good stocks, and we thought that if we might need to rebalance our portfolio, they would be a very good choice. Those stocks were Atul, Aarti India, Cummins India, Divi Labs, Viatech Webag and Britannia. Now this is one example of how we had analyzed our companies based on the investment approach that we had shown in the previous slide. First we had decided, like this was the format that we had used for analyzing our companies. The final list of stocks that we had used were these 10 stocks. These 10 stocks were present in our portfolio at all by the end of the period. Now I'll take you through the asset allocation strategy that we had taken. Over here we had used quantitative methods to find out the weights for each of our stocks, the 6 stocks that were there in the initial portfolio. The method that we had used was maximizing Sharpe ratio. Based on that, we have also shown our initial portfolio composition in the below graph. This is based on the weights that were given to those stocks. Now I'll take you through our risk management strategy. We had set a 10% stop loss criteria where we would have exited 60% from our stocks, and at a 15% loss we would have completely exited from that company. Now the reason why we chose such low levels of stop loss was because of the investment horizon. Because the investment horizon was only for 2 months. If we had invested, if we had invested for a longer time period, we would have surely gone for a stop loss of about 20% in the first case and 35% in the second case. Another risk management strategy that we had adopted was negative changes in the fundamentals. If there was any negative change in the fundamental during this 2-month period, we would have completely exited out of this company. But we did not, in the investment horizon that we were given, we did not come across such a scenario. The last strategy that we had adopted was that whenever a target price for any company was achieved, we changed the stop loss to the previous target price instead of squaring off from those companies completely. An example I would like to quote over here is in Amar Raja Batteries, when we had initially bought the stocks at 825 rupees, and then we had set a target of 842 rupees. Once we had reached the 842 target price, we had changed our stop loss for the next cycle to 842 rupees. This figure shows us the event calendar for the stocks that we had invested in, starting from beginning, which was when we invested into the stocks, that was on 2nd of January, and till the closure, that was on 3rd of March. So the blue boxes in the calendar are those dates where we had rebalanced our portfolio, and the company logos, the boxes which are showing the company logos, are those dates when those companies' quarterly results were announced. Now I'll take you through our weekly performances. So during our first week, we had incurred a negative return of minus 1.85%, which had increased in week 2 to about 2.28%. We had no portfolio change during this time period. In the third week, our returns increased further to 3.77%. Over here also, we had not made any changes in our portfolio. During week 4, we had seen a drastic increase in our returns to 6.06%. Over here, we had booked some partially booked profits in Bata, Amar Raja and HCL, and we had also invested into Cumins. We bought Cumins into our portfolio. During week 5, our returns dropped to about 4.69%. Here again we had completely squared off HCL, and we had made Atul, Aarti and Viatech Webag enter into our portfolio. Since week 6, our returns started increasing to 5.21%, then 5.63% in week 7, and by the end of week 8 we had a return of 6.27%. So during this time also we had made no changes in our portfolio. Now I'll take you through the results in a nutshell. Based on stock-wise performance, the returns of HCL was the highest and Idea was the lowest. And the below graph shows you the portfolio weekly returns. As you can see, we had consistently performed well, and our prices continuously, our returns continuously increased during the 9-week period. We ended up with a return of 6.86% at the end of our investment horizon, and we came second amongst the 7 teams that were present in the course. Now just a performance evaluation showing that in which stocks we had booked profit and in which stocks we had incurred losses. This shows that yeah, we did make certain mistakes and we could not perform well in certain stocks, but this was again a learning experience for all of us, as it is always said that you only have to do a very few things right in your life as long as you don't do too many wrong things. So our overall portfolio performance, as you can see in the figure, is our initial portfolio value was of about 1,25,000 rupees, which had increased to 1,33,579 rupees. This was about a 6.86% increase. Our highest gaining stock was 13.21% with HCL, and Idea we had incurred a loss of about 5.04%. Now, as you can see that the first graph shows our returns with respect to CNX 500. That was our benchmark that we had chosen. So we had been completely outperforming CNX 500 during this 2-month time period. The below graph shows the portfolio performance daily portfolio performance over a period of 2 months. So as you can see in the table beside it that we had an ROI of 6.8%, which was a net gain in INR terms of 8,579 rupees. The annualized ROI, if you calculate, would come up to be some 48.93%, and in INR terms it would be 61,158 rupees. So if same amount is invested into a fixed deposit, the annualized gain would have been around 12,000 rupees. So if we consider our ROI without brokerage, we had an ROI of about 8.20%. Now I'll take you through the performance evaluation. Our benchmark, as I mentioned before, was CNX 500. Over here we had calculated four different parameters. First was the information ratio, which came out to be 0.44. Next was the Sortino ratio, which came out to be 0.43. Trainers ratio came out to be 0.35, and our Jensen's alpha was 0.24. These ratios are very good considered as if you consider the amount of risk that we had taken. Also, I would like to take you through a comparative study between the benchmark and our portfolio in terms of the overall return. Our portfolio gave a return of 6.9%, while the benchmark gave a return of 6.7%. Though it is marginally up, but yeah, it is greater than the return that was given by our benchmark. The average daily return that was given by our portfolio was 0.25%, while that by benchmark was 0.16%. The daily volatility of our portfolio was 0.85%. For the benchmark it was 0.93%. So in terms of volatility also, our portfolio was comparatively lower. So Sharpe ratio that we obtained was 0.26, while for the benchmark it was 0.14. If you compare this, we can surely say that yeah, our portfolio performed very well, because for the same amount of risk that was taken, we had a better return compared to our benchmark. The other table at the side shows the 4-factor model, like the 4 factors in the 4-factor model. So Jensen's alpha, as I mentioned before, was 0.244. The beta market was 0.623. Beta SMB was 0.030. HML 0.255 and WML was 0.20. At the end, I would just say that this was one of the best learning experiences in our lives. We wouldn't have had such an experience if we wouldn't have been given this chance by our college. So just I would like to end up by saying this quote, that be fearful when the market is greedy and be greedy when the market is fearful. Thank you.
So what was your So what was your target price determination criteria?
So for determining the target price, we looked at the trend and the resistance and support. For means we basically look at the price momentum at that point of time. And after selecting the stocks, we looked at like which one is better to invest in at that point of time, and we went for it.
I'm not talking about stock selection. I'm just talking about the target price determination.
So target price, it was based upon the trend that was followed by that stock at that point of time.
So it was a technical
So there are,
analysis based.
okay, I want to add here.
Yeah,
There
please
are
add.
two criteria we took. First thing is analyst report taken from Bloomberg, because there are many analysts have given their reports. After fundamental analysis, we saw that which will be valid or not. Second thing, we took the trend line technical approach to, in a short term, decide the target price.
Can you just go back to the analysis slide, the portfolio analysis that you did, returns? Yeah, no. Next slide. Next one. Yeah, stay here. Yeah. Now, I have 2-3 questions for you here. You're saying the ROI is 6.86. I presume this is post the brokerage
Yes.
expense. So why would you then compare, ROI without brokerage? Because brokerage is something which is paid. It's an actual expense. So why would you want to justify the ROI without brokerage once again?
It's just to show, because the brokerage charge varies among the different platforms and clients. So if we will take the brokerage out, how much we can gain? Again,
Yeah,
that we
but
can.
nobody is going to let you trade without brokerage.
No.
So that's a market reality, right?
Yes.
So you have to factor that in. The second thing is annualized gain for fixed deposit. What is the reason for taking this as a benchmark? Was fixed deposit returns at any point in time your benchmark?
No, it's because it's always best to invest in capital market than to fixed in a fixed deposit. That's why we have compared how much you can take risk to gain something. Just a comparison.
How come none of your selection criteria throw up any financial company, which is today 28-30% of Nifty is finance? So how come, can you just take back there?
Yeah, sure.
Why not a single financial company came up?
Yeah. First thing, we have taken different financial criteria here. As per the criteria, the banking sectors are not covering in this criteria, and we have taken past 3 years for those data.
What is that criteria? Why banking?
Debt to equity ratio we have taken.
Oh, very high.
Yes, and for banking sector it is high.
Acha, in the performance attribution slide, you have also annualized your 2 months return.
Yes,
Is it a fair representation?
it's not fair just to.
So you just
extrapolate.
wanted
It
to
cannot
make
be
an unfair representation as
It
well.
cannot be totally fair because we have extrapolated this.
So
but
then
now-
why have you done it?
That's because, sir, we felt that in the last 2 months we saw many lows and high ups in the market. So we just had an assumption that the market might work in a similar manner in the next 1 year. It's just to extrapolate it to just get an.
So if the
hold
market
of
has
it.
to work in a similar manner, which means you are able to generate how much? What was the annualized return you represented? 48%. What is the equity return over the last 10, 20, 30, 40 years of the market? Annualized basis?
15 to 16% approximately.
And you have projected annualized return of 48%
Just-
based on your 2
yeah.
months performance.
It's just that if 2 months, if this is what, if the whole year replicates to our 2 months, is in that case.
So that's the question. Is it a fair representation?
not a fair
Is it
representation completely.
is it a
It's not.
practical way of representing equity returns?
No.
So then why
It's
have
not.
you done
It's
it?
not. It's just because yeah.
Pricing power was high, but the ROC or financial indicators were unsatisfactory.
Yeah, we actually chose market leaders in most of our industries. Like we had taken up Aarti Industries. So in Aarti Industries, we saw that it had a monopoly of being into bulk, into bulk. Yeah, into ortho nitro.
Sir, Aarti Industries, it's actually a market leader in producing the bulk chemicals, that is ortho-nitrochlorobenzene and para-nitrochlorobenzene, which are used in this paracetamols, which are generic drugs. So, because of this high market leader position, they have good prospect going forward as well. And second thing, with respect to the pricing power, again I'll give an example of Aarti Industries. For them, the basic raw material is the benzene. Now for them, they have a very high pricing power in this case, because whatever is the price fluctuation which is happening in their raw material, they are able to pass on to their customers, and because of which their EBITDA margin continues to remain the same. There's not much, although there's a difference in EBITDA, but the EBITDA percentage continues to remain the same. So they're able to maintain their pricing power in that respect.
The other thing you said is negative change in fundamentals was one of your criteria. So what negative change in fundamentals do you expect in 2 months?
Sir, this was again with respect to like the quarterly results which were coming out. So we were closely following the stocks, and also we were looking at the various analyst reports, company guidance and everything. So if there is any negative news coming with respect to basically with respect to fundamentals, not with respect to happenings in the stock market, but particularly with respect to the fundamentals, or is there any research analyst reports which we get indicating negative changes in the fundamentals? If those were the case, we have set the criteria that we would exit the stocks completely.
I'd like to highlight one point which I like very much. In the beginning, you very clearly upfront specified your investment objective, and I think you mentioned minimum 90% investment in equities, or other way around, not more than 10% in cash at any point of time. And leading towards the latter half of your investment horizon,